Hi, my name is Danielle Robinson, and today I'm going to talk about conducting a sensitivity analysis as a tool for capital budgeting. The agenda for today is sensitivity analysis, qualitative and quantitative steps, capital budgeting analysis, and the references used. Sensitivity analysis is a quantitative and qualitative technique used to predict the outcome of a decision given a certain range of variables. In business, this analysis helps in understanding the impact of uncertainty in key assumptions and aids in risk management. Qualitative explores subjective experiences and insights, while quantitative focuses on measurable and statistical data. Please read through the essential steps of conducting a sensitivity analysis as I explain further. This process helps us understand how various factors can impact our business case. First step is a review of the business case. This qualitative review focuses on identifying potential drivers of cost and benefits. Next step is to manage scenarios. For our base case, we'll compile starting points based on our assumptions. Using Excel Scenario Manager, we can analyze variables such as incremental sales, lost sales, cost of goods sold, advertising expenses, new product management salaries, market research expenses, capital required for new equipment, and incremental maintenance expenses. Managers would need to develop those scenarios with various expenses. By examining each variable and applying different ranges, the goal is to see how they influence different outcomes. Summarizing the scenarios by utilizing the Excel summary button can be a great tool to compile all information. The third step is to measure profit by calculating the internal rate of return. This metric helps evaluate the discount factor and determine when the discounted net cash flows reach zero. It's also important to vary the discount rate input, which is the fourth step. This discount rate affects the relationship between fixed and variable costs, as well as the amount of debt financing our company utilizes. Finally, the last step is to use the Goal-Seek tool. The Goal-Seek tool is the last step. It involves evaluating the results to determine the necessary input value that will help achieve our desired outcome. By following these steps, businesses can effectively assess the sensitivity of the financial models and make informed decisions that drive success. I'll outline the essential steps for conducting a thorough risk analysis divided into qualitative and quantitative approaches. For the qualitative steps, number one, or the first step, is to identify key variables. You identify key variables by determining which variables are critical to your decision-making process. Second, you gather expert opinions by consulting with experts or stakeholders to gain insights into the potential range and impact of those variables. And then third, you define scenarios. Create various scenarios that reflect different situations based on the variability of your inputs. For the quantitative steps, you model development by building a mathematical model that incorporates all the key variables we've identified. Second, is the data collection, which gathers numerical data for these variables using historical data or forecasts. And third, conduct analysis by changing one variable at a time or multiple variables simultaneously within your model to observe how these changes affect outcomes. And then fourth, you interpret results by analyzing the results to identify which variables have the most significant impact on your business model, enabling informed decision making. By following these qualitative and quantitative steps, businesses can effectively assess risk, leading to better decisions that align with strategic goals. Key components of capital budgeting analysis include cash flow estimate, which entails forecasting the expected inflows and outflows of cash over the life of the investment, including initial costs, operating revenues, expenses, and eventual salvage value. Investment appraisal techniques are also utilized to evaluate the project's financial viability. Additionally, risk assessment plays a crucial role in capital budgeting analysis by analyzing potential risk associated with the investment, such as market volatility, operational risk, and financial uncertainties. Based on this thorough analysis, management can make informed decisions about whether to proceed with the investment, adjust the project, or abandon it altogether. The importance of capital budgeting analysis lies in its ability to ensure optimal allocation of resources to projects that are expected to generate the highest returns. It aids in long-term strategic planning by aligning investments with businesses' objectives and provides a framework for assessing the financial implications of significant expenditures, thereby reducing uncertainty and risk. Overall, capital budgeting analysis is crucial for effective financial management and strategic decision-making in organizations, allowing them to maximize profitability and achieve growth. I want to highlight the key aspects of capital budgeting analysis. At its core, this process involves estimating cash flows, which includes predicting the expected inflows and outflows over the investment's lifetime, covering initial costs, operating revenues, expenses, and salvage value. Businesses utilize investment appraisal techniques to assess the financial capabilities of projects and perform risk assessments to identify potential market volatility and operational uncertainties. This thorough analysis empowers management to make informed decisions. It also guides decision makers on whether to proceed with an investment, adjust it, or abandon it altogether. The significance of capital budgeting lies in its ability to allocate resources effectively, ensuring investments align with business objectives and yield the highest returns. It provides a framework for evaluating financial implications, ultimately reducing uncertainty and risk. In essence, capital budgeting analysis is vital for effective financial management and strategic decision making, enabling organizations to maximize profitability and achieve growth. References used. Thank you.